The sensex is down. The small cap index is down about 1/3%. And I think you've got the mid cap index, which is down about 0.5% as well. 56,400 on the mid cap index coming through as well. So unexpected lines, 24,700 now on the Nifty. So ticking down a little bit. Heat map coming up on the Nifty. And it's largely on the downside with few gainers, about 8 or 9 gainers, but everything else is starting in the red. Rima.
The Nifty at open has lost more than 100 points. So it's currently at 24,700. IndusInd Bank is your top loser straight away, 4% lower, 740 on IndusInd Bank. IT is on the back foot. Cuts of more than 1% on HCL Tech, on Tech Mahindra, on Infosys, on TCS. This is following the 1.5% knock that we had on Nasdaq overnight. ITC is weak ahead of its numbers later today. ITC share price is opened with a cut of nearly 1%, and Reliance Industries is also exerting pressure with a downtake today. Other notable drags include a Power Grid, a Shriram Finance, a Nestle, Trend. So a couple of these consumption names, FMCG names, also weak in trade. There is only one Nifty stock with a gain of 1%, and that's Adani Ports. So that's the top gainer right now. But other than that, Adani Enterprises, Coal India, BPCL have a green tick. ONGC should also come up for you on your screen, reacting to numbers. ONGC share price is up nearly about 0.5%.
Well, that's right. You know, this company we just spoke to, Bartek Babak, just take a look at that stock. Bursting away, the stock is up closer to 9%. Big up move is what we're seeing out there. In the final minutes of trade, in fact, we did have NTPC Green that came out with a set of numbers. Bazooka move out there. Remember, the stock had danced away. I think it had given a 40-50% return post its listing. But post that, it did pull back to the IPO price. And now, in fact, it's getting back into form. So that stock is up and about in today's trading session. A couple of other big movers in trade today. Nalco, the numbers are good. The stock pops up closer around 3%. Sustaining this gain is going to be important. And a couple of other notable movers on large volumes. You have Dishman Pharma. I think that one, in fact, is up close to around 8% now. VRL Logistics. On the top line, it was a bit of a disappointment, but it seems the management is now focusing on the operational performance. And the margins actually were a pleasant surprise out there. So that's why that stock is up close to around 7.5%. Big move is what we're seeing out there. And Cosmos First. That's the other one that's trading with good gains as we speak. So a couple of these stocks actually doing very, very well from the broader markets. On the flip side, a few stocks that are getting clobbered. You have AG Infra, that's down close to around 8%. So big downtick is what we're seeing out there. JMM Pfaudler as well, it lost its form, and now, in fact, in a post that it's never been able to get back into form. So JMM Pfaudler as well, down close to around 5% as we speak. The market's now at the low point of the day. IndusInd Bank, that's the top loser, but in fact, it's pulled back some losses from the lows of the day, now down only approximately 3%.
Okay, well, I think so. It's a downtick just under 24,700 on the indices as we begin this session on Thursday. Gautam Shah is with us, founder Goldilocks Global Research. He's joining us to take some questions on markets. Gautam, great to have you here. Thanks for joining us. You know, it just seems the market's done quite a bit, coming back sharply, and everyone is now, of course, a little confused about is there more upside here broadly, or do we go into a bit of a tailspin of consolidation? And overall, the mood is not helping. I mean, you look at what's happened, worries around the Japanese bond market, US bond market. So there are these small localized tremors, earthquakes, whatever you want to call it. Keeps popping up once, every now and then, keeping everyone on their toes. So it's not all clear in that sense. And of course, there is this big thing of tariffs. What's your sense, Gautam? Do you see a clean run, or do you see a much more fractured kind of path from here?
Good morning, Prashant. Mood not helping is actually good news because it keeps the bull market in check. I think we've handled a lot of local and global stress in the last few months, and the markets have come out with flying colors. The fact that you are at such elevated levels of 25,000 itself, I think, is a big win. I don't think many people in the market would have thought that we can come to such levels so quickly. And I do see bull market characteristics. I mean, if you look at the momentum, the participation, the way India has handled the news flow, local and global, I do believe that we are headed significantly higher. And, these issues that keep propping up from time to time, I think is quite normal because I think we live in a world where something has to happen on a daily basis. But the price action has been super solid. There are no concerns on the charts. The market is not even significantly overbought. In fact, in the last 1 week, we've just gone a little sideways after such a big rally. And you have immediate support at 24,500 and possibly 23,800, which is more of an investor support. So keeping all of these factors in mind, I do believe that this dip is a buying opportunity. And I do see the Nifty moving towards a level of 25,600 and eventually lifetime highs. And I do see a wave of outperformance for the mid caps and small caps. So I think one should be invested. Even the US market setup is quite solid, and we see those markets hitting lifetime highs as well. So I don't see, as a technician, I don't see any concerns on the charts, and I think the markets are in fine form.
Okay, so 2,500 is the immediate stop, then all-time high levels, mid and small caps outperform. You spoke about US markets, Gautam, and I see Goldilocks has done a lot of research on the US markets. Your first big picture report for the US pack is out. So tell us a little bit more about the US markets, because overnight they went into a tizzy following the surge in bond yields. So that is emanating as a bit of a concern. So considering there are linkages between what happens in the US and back home in India, what's the call on the US markets, top down?
Yes, Reema, so we closely track all the US market indices, the ETFs and the top stocks. And I think since we have a product there, I think we now have a better understanding of what's happening in the US. And, after the Trump talk and the fall that we saw, again, not many people globally would have thought that US markets will come back so strongly, and they have. So I think the men have been separated from the boys, not just India, but world over, including the US. And I do see the S&P 500 moving towards a level of 6150. In fact, even the Russell 2000, which tracks the mid caps and the small caps, is coming back really well. So I think globally, I don't see a problem. I mean, even if you look at Europe, markets like London, Germany, France, all very strong. Asia has been relatively strong. Look at Taiwan, look at Singapore. So I think globally we remain in a bull market. That's what I want to call. I know it's very early to call for a lot of people, but the characteristics globally suggest that we are in a bull market, and this is only going to help India, which anyway has a lot of standalone positives.
Okay, all right. Ooh, the Nifty actually, as we speak, it's actually drifting lower. We're at around that 24,600 mark, which incidentally is one of the important support zones. So this 24,500, 24,600 is the important zone. Hi, Gautam. Good to hear your comments. You're sounding quite bullish on global equities and India included. What about the Nifty Bank? That's been the leader, right? I mean, it saw a lot of selling, the FI selling, it underperformed for a period. And then when it found its form, well, it took the Nifty higher. What's your take?
Yeah, I think in the difficult period of October to March 25, the Bank Nifty actually did not go down as much as the overall market. I think that was the key takeaway, that the banks have inherent strength. And thereafter, Bank Nifty single-handedly, took the Nifty higher from levels of 50,000 to about 56,500. It's consolidated beautifully in the last 10 to 15 days. It just passed on the baton to some of the other sectors. And you might have noticed how technology, metals, capital goods, real estates, FMCG started to do well. But I think this breather phase for Bank Nifty is likely to end. And once the level of 56,000 is cleared, I think Bank Nifty is headed towards a level of 60,000. And when I see all the top stocks, I remain quite encouraged that they will do well. But one thing is very clear, that the movement or the outperformance is now shifted to some other sectors. And I continue to believe that metals will be one of the star performers of the next 6 to 12 months.
Metals will be one of the, I think it's a view that you've had in the last time we spoke as well. And out of the pack, you'd recommend buying a bunch here on the metal side, or anything in particular, Gautam?
See, a couple of days back, the metals index hit the first resistance of 93.50. And I think once that number is taken out, you are heading towards a level of 10,500. That's about 12% upside from where we are. And typically the iron and steel producers are the ones that we like the most. But I think everything will be a beneficiary. We've seen in the last 4 years that when a theme works, everything does well. And that's what is likely to happen with metals. So the top 6 or 7 names across the board, ferrous and non-ferrous metals, I think will be an outperformer. See, the Nifty is not going to give you supernormal returns from here. You have to be in the right themes. And I think real estate, PSU and metals are 3 pockets which I think will see serious outperformance.
3 pockets. You said real estate, metals, and the other one is?
PSU. I think PSU, after a mega run for about 2.5 years, went through a consolidation for about 8 to 9 months. And I see the entire basket coming out beautifully in the last few weeks. And I think there is clearly a lot more money to be made there because valuations are comfortable. These are companies that don't have anything to do with foreign soil. And I think the structure is beautiful after that, initial run up. So I think PSU, given all of these factors, stands out for me for the next 6 to 12 months.
So PSUs in banks, are you talking about defense? Are you talking about power, oil and gas, and any stocks or any trades?
See, I think it's going to be across the board, even though we love the top 3 PSU banking names. So I think that's one focus area, the PSU power names, the PSU infrastructure names, and the PSU oil and gas names. These are the pockets that we like. Defense and railway, I know they've done very well in the last 15 days, but I don't think the risk reward is justified to go long here. But apart from these 2 pockets, the entire basket of PSUs, including the PSU metal names, I think will stand out.
Okay, all right. What about Reliance Industries, Gautam? That's like an index by itself. And that went through a big period of underperformance and bounced off that 1100 odd mark. And it's done quite well from there. Any view on this one?
Yeah, I think it's good to see that the underperformance has at least ended. It tested a level of about 1110. From there, we've seen a 300 rupee rally. Structure is looking a lot more comfortable. But will Reliance see major outperformance here? The answer is no. At the same time, it's not going to fall much. So I do see a gradual move up on Reliance. And, if you have 3 big pockets of the market, which is banks, IT and Reliance, all having good setups on the charts, you can't have the markets go down too much. And that's the reason I feel at today's level of 24,600, the market remains a buy risk reward.
By the way, sorry.
I was mentioning that IndusInd is
moved in the green.
The green. And this is what I was saying in the morning. I mean, if you look at the last 1 month, there's been so much bad news where the stock is not selling off. Everything has been, and there's been a lot of supply. All of it has been absorbed without breaking the price. So, people still hopeful that, it's just a valuation game that you're buying something which is now beaten down, depressed, and maybe there is some money to be made from here. So we'll see. You, of course, heard, Digant, who thinks it's lastly going to be a trading game. 600 to 800 was his range broadly, but doesn't really, do very much point to point a year down the line. Of course, Hetal was also with us in the morning on IndusInd. 210 lower on the Nifty is what you have. On real estate, Gautam, what are your picks?
Again, I'm sticking to the top names. I think real estate is a structural trend for the next 3 to 5 years. That's the way I want to look at it. Went through a nice 1 year of consolidation. If you look at DLF, Godrej Properties, Oberoi Realty, Brigade, Prestige, Shobha, all went through a large consolidation in the last 1 year. And they all seem to be creating a foundation for the next leg up. You can't play India and not play real estate. I think it's a direct proxy to the India story, which banks were for a long period of time. So I think given the valuations, given what I'm hearing on the ground, what I'm hearing from many of my clients, I think real estate from a risk reward perspective stands out, and the index could actually see a 20% appreciation from these levels.
Gautam, great conversation. Thank you very much for joining in. The Nifty, though, is still down close to about 200 odd points, even as IndusInd Bank has recovered back in the green. Some of the drags include IT. In fact, IT is under severe pressure. Tech Mahindra, HCL Tech, both down over 2%. And then you've got ITC too, weak. But let's talk about Uno Minda's Q4 performance. The company reported largely an inline set of Q4 earnings. Switches lighting segment continued to see growth of more than 20%. Management expects business to grow more than 1.5 times the industry growth rate. To talk about the performance, Sunil Bora, Group CFO of Uno Minda, is now with us on the show. Thank you very much for joining in. While margins are still on the whole within your guided band of 11% plus or minus 50 basis points, in Q4 there was a drop of 100 basis points in your margins. What led to that? And do you think you can increase what's the guidance on margins going ahead? Do you think there is scope to, for margins to cross 12% in FY26?
Yeah, so first, you mentioned that from year-to-year perspective, there is a margin softening of almost 80 basis points. And that is primarily because in the last Q4, we had some good price settlement with some of our customers which were delayed. But as we have guided, our overall profits have been within the range of 11% plus minus 50 basis points. And that's the guidance we are maintaining for FY26 as well. The key reason being, even though we are expecting growth and we are not able to see the benefit of operating leverage, in our bottom line is primarily because we are in a very high growth phase. We have multiple plants, businesses which are under startup phase or under phase where they are in the construction and will come into operation phase in the next fiscal year. So as you know, any new business or any new plant we start, normally you will have a lot of startup costs and initially you are into ramp up phase. So first year or two are actually in the investment phase where you don't get any returns. In fact, first year you might be actually in negative zone, but gradually you ride the growth phase and once the plant stabilize, our target always has been in the third full year of production, we should achieve our guided profitability or targeted profitability. So that 11% plus minus 50%, 50 basis points actually factors in all those startup costs and initial ramp-up costs. And despite that, we are able to hold on to our margins. So if you exclude that, actually we might be improving our profitability if you see on apple-to-apple basis.
Hi, Mr. Bora. Good morning and good to see you in. Nigel on this side. Well, India and UK, they have recently signed those FTAs. And even the India as well as the US are likely to announce at least the first part of the bilateral trade deal. You have talked about additional opportunities, right? Do you see signs of that? And could that be a potential benefit for your company from the UK-India FTA?
Absolutely, Nigel. From UK-India FTA, as of now, we have not been having any significant exposure to UK. But we do hope as things stabilize, as the taxes comes down, we should gradually become more competitive. But coming to India, US, we have good exports, even though it's overall pie, it's not very high. Our revenue from US markets is less than 2% of our total revenues. But we do remain optimistic. We are seeing positive traction, discussion with our customers. And we are cautiously optimistic in terms of the discussions going on between the two nations. And hopefully, whatever we are hearing from the government in US or the officials from the US, there seems like the auto component sector or the tier 1 sector might get good relief for imports into US. So from that perspective, we are seeing very good traction. And the discussion with our customers are in a positive zone in terms of maybe increasing our businesses as we move forward.
Sunil, hi, morning, Prashant here, and good to speak with you. You can't put numbers. It's too early, right? You can't put any numbers to it in terms of what it could mean. Volume of business going up. It's too early.
It's little early, but Prashant, I can tell that even in the current phase, before this 90-day pause, obviously we have been in discussion with our customers, and the feedback we have been getting from customers was positive. In terms of the business continuity and expansion of that business also. We are in the process of evaluating few more RFQs which customers have issued to us. So hopefully as we move forward, in absolute terms, the revenue from that region, we do expect to go up. Yes, it is tough to put numbers on the table today, but we don't see any significant degrowth from that perspective. In fact, if at all, we are looking at upside only as we move into the near future.
What about Europe? That is UK, but what about Europe? I think here there are still headwinds, right? Cheaper imports, higher production costs, and of course, generally, it's just been a sluggish demand environment, region-wise.
No, you are right, Prashant. Region-wise, the volumes are significantly lower. So we have like both sides of the coin. We have a couple of key businesses there, one in Spain and one in Germany. So the Spanish business obviously is a horn business which is facing challenge because that is directly linked to the vehicle volumes. Even though we have not lost any share of business, the volumes are significantly down, and that is what is showing up in our numbers as well. So like last quarter, our revenue from those operations is down by almost 25 crores in the quarter. But in Germany, things are looking better. Even though the volumes are down, we are looking at some new businesses which we feel will be able to more than offset the volume drop or the impact of the volume drop. So as of now, it's industry-wide. If you see, yes, volumes are lower, but we are looking at optimistically in terms of new business additions.
Sorry, what's the contribution of Europe and what's the extent of pressure?
Yeah, so in terms of revenues from Europe, from our Clarton Horn subsidiary is something around 400 odd crores of revenue, and same broadly number is from the German business. And in terms of volumes, the volumes are down almost like 10 to 15%, which is what is mirroring in our Clarton Horn revenues.
Okay. Can you give Sunil some more color on your various divisions like switches, lighting, castings? What is the growth that you anticipate? What are the trends that you're seeing for FY26?
No, you are right. So if you see, a lot of our businesses do continue to ride on the premiumization theme. If you start with switches, we continue to hold on to our lion's share in both the businesses, be it the four-wheeler switches or two-wheeler switches, both in more than 50% market share. We are seeing a lot of upgradation in the switches, be it the haptic-based switches, touch-based switches, a lot of premiumization happening in that. We are also gradually increasing our share of exports into those businesses. If you see alloy wheel, yes, alloy wheel last year has been, in terms of application ratio, has been almost stable. So application ratio, when we say, it is like alloy wheel versus steel wheel. So it has been almost in between 40 to 45% range for last couple of years. But globally, if we see, it is more than 80-85%. So India obviously will ride that journey, but it might not be in a short time frame. It might take few years. But maybe last year was our consolidation phase. And in terms of tool alloy wheel, we have consistently been expanding our capacities in line with what we have done in four-wheeler wheel. Two-wheeler wheel, we have grown from 6 million wheel now to 8 million wheels, which is fully operational and fully booked. We have announced another 1.5 million wheel capacity in Bawal. So we are consistently, we are expanding our capacities, and there is a good demand we are seeing in the alloy wheel segment. Moving to some of the other segments like lighting, you said lighting has been one of our very strong growth area, which we have been able to successfully increase our market share in last couple of years, specifically in four-wheel lighting. Even in two-wheeler lighting, we are almost like 30% market share. So things are looking much better, and there is a lot of focus on innovation, technology, R&D, etc. In fact, recently we have also opened a new tech center in Czech Republic to support our four-wheel lighting business. So there is a lot of action happening on all that. And if you see from growth perspective, and our target has always been to do at least 1.5x of the industry growth. And if you see last year, we have done industry grew over by 9%, we grew by 20%. So that clearly demonstrates our commitment. And we do hope that as we move forward, we should be able to deliver at least 1.5x of the industry growth based on all these factors which I just spoke about.
Okay, all right, Mr. Bora, very quickly, before we let you go, could you tell us what's the current content per vehicle? What's the difference between, say, an ICE as well as an EV? And where do you see the content per vehicle number headed?
So content per vehicle, if I see broadly in the two-wheeler segment, currently stands roughly around 12,000 rupees for ICE and roughly around 35 to 40,000 rupees for an EV two-wheeler. And in terms of PV, it ranges very, very widely. So if you see, it is for the top end almost like 2.25 lakh for a D segment car for ICE engine, and for EV, you can add another roughly 1 to 1.5 lakh rupees of kit value on top of that.
All right. We have Sunil, thank you very much. I think that's a fair bit of detail, and look forward to our next conversation. Thank you indeed for joining us. Let's focus on the next company, which of course has been in news, with the news flow actually taking a bite out of the stock price over the last 3 days. Protean eGov Tech is the company in focus. Of course, the news was that they've not been shortlisted for PAN 2.0 by the IT department. The market did not take the news flow too kindly. But they've reported numbers now as well. Suresh Sethi is MD and CEO at Protean eGov. Mr. Sethi, good morning. Great to have you with us here. Prashant this side. So let's just start with that setback in that sense. How do you... so let me ask you, and I think you, in that conference call to analysts, you did explain that you don't see that as a bit of a setback. Why is that? What is the difference between what the PAN work that you are doing and the scope of work for PAN 2.0 why would this not really sort of take a bite out of the growth for future years, which many were building in? Go on.
Sure, Prashant. I think it's critical to understand the PAN application process. So there is basically when an applicant is applying for the PAN card, there is the complete collation of data, collection of data, and securely transmitting to the ITD. So today as Protean, we run multiple online and offline channels. We have a well-regulated network of almost 400,000 agents at which a citizen can go and submit their information or submit information for updation of a PAN card. And this is transmitted securely to the IT department. The IT department today runs the system through which the allotment of the PAN number is provided. And once they allot the PAN number, then the same is given back to us and we issue the PAN card and we send it to the citizen. Now, the entire tech stack, which is used for allotment, is a system which is run completely by ITD. And that is something we don't even do today. We run largely the processing and the issuance of the PAN card. So we don't see the two being sort of, on the same track. And while it was critical and a excellent opportunity to further deepen our relationship with the IT department, our current business continues as is. And equally important is the fact that the PAN 2.0 from deployment or allotment is going to be another 18 months journey. And it will be looking at online channels at that stage.
So in a way, it's like what TCS does for the passport service, right? That's what you do with regards to PAN.
You can make a similar analogy.
I mean, I'm just trying to simply, that's much better understood.
And Prashant, just to add over here, it's also critical because it's a citizen-centric service. Today, a lot of citizens, actually 70% of them still go through an assisted mode. These are digital non-natives who absolutely want some support to be able to apply for a PAN card. And therefore, the network becomes very, very critical and important to support them.
Mr. Sethi, what was the reason that you were not shortlisted?
We have sought a clarification from the IT department as of now, and we await to hear from them.
Do you think it's technical in nature, or would it be something else? I mean,
no, there are basically 3 rounds of, if you may, a qualification. There's a pre-qual, there's a qualification, and there's the price discovery at which multiple bidders go in and there's a fair and transparent way of discovering the price of the project. This was at the qualification stage where along with us, the other competitors have also been in a way indicated that they didn't make it to the last round, and one final competitor has made it to the last round. All this information is available on the GEM CPP portal.
So which is the company which will now be doing PAN 2.0?
It is available on the portal yet because as of now, they still have to do the price discovery round.
What's the scope of work, Mr. Sethi? What's the size of work here?
The scope of work is basically revamping, deploying, designing and integrating and maintaining the core IT systems, which, as I mentioned, are being run by the IT department themselves as we speak.
Okay.
Can you put a number value to it?
There was a budget shared by the government, which is there in public domain. It can always be referred to.
Can you, since we have you, it's easier to ask you. Is it possible for you to share that?
It was indicated as a 1400 CR budget.
Over what period of time? This is like
So as I mentioned, the design and the deployment of the stack is supposed to be done in the period of 18 months, post which there'll be a maintenance period for the same stack.
Okay. So today, PAN is 50% of your revenues, right?
Yes, almost.
Okay. And for the next 18 months, it's business as usual.
I would say that the service...
Or will there be a drop-off in revenues?
Exactly. So service models, as we see how they evolve down the line, because as I mentioned, we today also have online and offline channels for people to apply for the PAN card. But 70% of the people go to our assisted points of service where we run a regulated network of almost 400,000 agents covering the country. We don't know what the service models will evolve in a couple of years, but largely will be driven by the citizen's choice of how they want to apply for a foundational ID like PAN.
Okay, but just, simplistically, for the shareholders, revenue will continue to drop off and come to zero, say after 18 months. And after 18 months, what is your own expectation?
No, so again, I'm reiterating, 18 months, the new stack does not come into play. Down the line, also, as I'm saying, we don't know the service models, how they will pan out. Today, citizens do take assisted services. 70% go through that mode. And we expect it will be driven by the consumer choice. So the distribution and the issuance business is separated out from PAN 2.0 and what it will bring at that stage.
All right. Hi, Mr. Sethi. So clearly this 50% of your business has gone into a bit of a tailspin and there is some uncertainty out here. Now, you'll have to try to fill in the gap, right? What are the avenues you are looking at, both domestically as well as internationally, to fill in this gap? If you could tell us that. And
no, but first of all, let me say there is no gap. As I mentioned already, the PAN 2.0 talks about the revamp of the core IT systems of ITD, which we don't do today. What
Right.
we are running is the distribution for collating the PAN data or PAN updates and transmitting it securely to the IT department. We today also have both online and offline channels to do it. So our
Yes.
business continues as is the mandate given to us by ITD in 2003.
So you'll continue to grow then, because the street is clearly not buying this. As you have said in the last con call as well, you said that business will not be impacted, but the street is very, very nervous. You're looking at a couple of sales notes out here. I'll tell you what's the problem. The problem is on 50% of your revenues, that was the cash cow. So if you were to get into new verticals, the street was positive on that. They were expecting you to get more business out there. Suddenly that goes out of the way. So if you're saying it's not going to impact business, do you expect to grow from here on?
No, so absolutely. As we see, PAN is not a saturation ID. We are seeing new PANs getting issued up till 6 to 7 CR every year. And we have almost a 57% market share. We gained 5% market share during the course of this year. So we expect this business to be aligned with the issuance of PAN. And citizens today, if you may, only 35% penetration of PAN is there in the country. It's not a foundational ID, the lines of Aadhaar, which is 99% penetrated.
Yeah.
So there is a huge headroom over there for new PAN cards to be issued.
All right. If you could help us out with the growth guidance then?
So definitely, as we've been saying earlier, we expect 6 to 7 CR PAN cards to be issued. We currently have
Revenue growth guidance, sir. For as a company, what kind of revenue growth can we look at?
Yeah, so as you were saying, we are looking at other areas, goes without saying. So we have clearly gone into multiple open digital ecosystems. We are working in the space of agri, health, digital commerce, ONDC. Likewise, we are introducing products on top of our identity services business,
Yes.
Pro and Rise we've spoken about. So we clearly see a good trajectory for the company in new businesses, and the core businesses remain strong, including the pension business, where we have a 97% market share as of now.
Okay, just a couple of more questions. In the last quarter, there's a big jump in other expenditure. Any one-off was there?
No, there's no one-offs.
No one-offs. Okay, all right. Because there's quite a sizable jump, even if I look at it on a sequential basis. Also on ONDC revenues, could you tell us what is the outlook out there? It seems that, it is plateauing at around 7 million per month. But you were optimistic on that, right? So what was the revenue in the last year, and how do you see that panning out?
Yeah, sure. So there are two parts to the revenue that we accrue from the ONDC business. So one, we are running the foundational gateway and registry, which today, as we mentioned, is directly compensating by the ONDC as an entity. And that is where the network play comes into play. And this is foundational. The other area where we were looking at was a SaaS sort of a business model where you are creating the demand and supply applications. Now, the demand and supply applications clearly get linked to the fact that as the network grows and there is more consumption, you will get paid for every transaction. So we hope, as we've seen, that ONDC is gaining traction. There has been growth, but clearly we have to hit an inflection point, and the SaaS revenues are what will pick up from here onwards.
What is the revenue, though, for the past year?
So the past year, we had around 8 CR of revenue coming from the core stack, and the revenue coming from the SaaS business was pretty limited at this stage.
Mr. Sethi, you've approved a scheme of demerger, right? Protean InfoSec Services. Could you tell us what does the subsidiary do, and what is the logic behind this?
So initially, we had established a subsidiary to look at our InfoSec vertical. We are clearly also looking at aligning and coordinating that business with our cloud services business. We find a lot of alignment in that business because, end of the day, any cloud deployment involves a lot of cybersecurity and security-related considerations. So we are bringing the two businesses together to take it as a common business to market.
Which two businesses? Cloud
services and InfoSec.
And what is InfoSec exactly?
InfoSec is information security, to running any SOC centers, doing VAPTs, doing various sort of services for the consumers in the space of containing any security threats on the InfoSec perspective. Okay.
Just one last question. You said there's only for PAN issuance, penetration is still quite, you said 35%, right?
That's right.
And 6 to 7 crore PAN cards to be issued over what period? This is
an annual figure we generally see, because that is what we've been seeing as the run rate for the last few years.
And you're able to do this without, you'll do this in FY26 as well? I mean, it should be in this ballpark.
Absolutely.
Okay, all right. We'll leave it there. Thank you very much, Mr. Sethi, for joining us and answering all those questions. And, look forward to when you get to know, as you said, you've asked for a clarification. Do let us know as well in terms of what led to you not qualifying for that PAN 2.0. So we'll look forward to that. Thank you very much. We'll take a quick commercial break here. Gokuldas Exports is going to be with us on the other side to talk about their fourth quarter performance and, of course, the outlook forward. Stay tuned.
Welcome back. More earnings interactions. Gokuldas Exports reported a good performance in Q4 and FY25. Top line growth was about 25%. Siva Ramakrishnan Ganapati, Vice Chairman and MD of the company, is now with us on the show. Thank you very much for joining in. 25% revenue growth year on year, 3% on a quarter-on-quarter basis. On a year-on-year basis, what was the impact of the acquired entity? And going ahead in FY26, what's the outlook?
So the acquired entities have started performing well, and between Atraco and Matrix, we had about 850 crores plus another 450 crores. So about 1,300 crores come from there out of the total 3,900 crores. So that's the kind of split of revenue coming from the acquired entities. All of the entities have grown. The base business itself has grown substantially, where the erstwhile Gokuldas itself has grown pretty strongly, both in Q4 as well as for the whole year. And we have been growing at a much faster pace than the rest of the industry.
Okay, all right. Hi, sir. Good to see you, Ben. Just to clarify, one acquisition that you made was BRFL, right? That hasn't yet contributed in the past year.
No, we have just made an investment. We have not acquired them as yet.
Not acquired.
Them. That's right.
All right. So got that. Now, if you could tell us what is the current order book, if you could give us a brief idea, because that gives us some kind of visibility going ahead.
So the order book is strong, and we have booked all the way till the second quarter. So we have a fairly good amount of order flow happening. There are certain concerns from the customer side with tariff and uncertainties, etc. But we seem to have been overcoming that and generally having a reasonable state of booking. So we don't have as much concern, though. I feel that in the longer run, I think given the macroeconomics and the geopolitics that is going on, India should be in a stronger position, especially with UK FTA happening. Hopefully, an FTA with EU and US also, tariff agreement being reached. Then we will see better traction. In the interim, in the short term, tariff may play havoc with short-term business. We will have to just deal with it. We will have to, contend with those uncertainties and manage the business through that period.
Okay, all right. So, the last time we spoke, you said that India is better off if you compare it with other countries, China, Vietnam, Bangladesh as well. Is that still the case? Given the sudden talks between China as well as the United States, has some of our edge got taken away?
So China, it was impossible for China to export anything to US when the tariff was at 145%. Now that it has come down to 130%, there is some trade resumption between China and US. Having said that, a 30% tariff is still high. and we will definitely have an advantage over China. But what's important to see is how does the tariff eventually play out for other competing countries like Vietnam, Bangladesh, Indonesia, etc., because that's where bulk of the larger customers have pivoted already to. So the relative tariff post this 90-day pause window is what will determine, in the longer run, who will have what advantage. At the moment, there's a level playing field for everyone in this Asian region, barring China.
You had guided for improving EBITDA margins to 12%, and I think you've achieved that. Now, going ahead, what is the outlook on EBITDA? Can you further increase it? And considering you get about 70-80% of the, your revenues from the US, and there are going to be tariffs to some extent, what are your conversations with customers like Gap, for instance? Are they asking you to bear a part of the impact?
See, all customers are asking us to bear an impact of the tariff. So in the short term, which is say the first half of this year, when the tariff will be in play. For example, the revised tariff or reciprocal tariff started from April 9th, so it's impacting Q1. So we do have to share some amount of our margin with our customers. The supply chain contributes to bearing the tariff as well. So in the interim, to keep up our relationships and to make sure that we continue to grow, we will have to forego some margin. So Q1 and Q2, we will have some, setback on margin. So this year will have some tariff-related challenges. If I exclude that, I don't see any problem for us. We will continue our growth journey both on top line and on the margins. But tariff will certainly impact our margins. Tariff will also bring in volatility of business volumes. At the moment, we don't know what the tariff is after July 9th, after the 90-day pause window. So will it go back up to the 26% announced earlier? Will it stay at 10%? Most of the customers who are placing orders today will receive their goods after the tariff pause window.
Yes.
So how do you place an order now without knowing clearly what is the tariff at which you're going to clear the goods when it comes into the United States? So this is a big concern, and that brings in a short-term volatility. But, we are building the business for the long term. And when you look at the long term, we don't seem to have those kind of concerns. In the short term, we definitely will have this problem.
So say for H1 of FY26, what's your own expectation of EBITDA margins?
It's very difficult to predict. I'm sorry to say that because I don't even know what's the tariff going to be in Q2. So how can I predict that margin? How do I know what kind of burden share that we are talking about in the second quarter? Our endeavor will be to protect our margins as much as possible, but we are living in an uncertain times where we don't even know what are going to be some of the tariffs. So it's hard to predict margins in such an environment.
Fair enough. Okay, but you are sharing some of the burden with your customers, and that could keep your margin subdued. That's the key takeaway from that. Okay, you'd also spoken about a 15% kind of a revenue growth driven by a strong order book, sourcing trends, etc. Is that on track?
So again, long term, 100% it's on track. Short term, there will be some aberrations. When I say Q1 and Q2, there could be some order flow hiccups, primarily because customers themselves are unaware as to how the tariff is going to impact them, and hence how do they go and build up their inventory. So if I buy now for holiday season, which is the winter season, most of the production will happen in Q2 of our financial year. What is the tariff?
So orders have been paused, sir?
Orders have not been paused. Orders are coming through, but the brands are just concerned about the order flow. So they may trickle it down. I don't see an order flow problem, but I see some volatility again because of unknown tariff.
And ROCE, you had plans to, I think, scale it up to 20% plus.
Yes.
When does that happen?
I think it'll take 2 years, and it will happen. One of the reasons why ROC is showing a slight dip now is because we have made investments in several capexes, capacity increases. So we are also trying, filling up those capacities. So planning to do that, and those have yet to come on stream. So these are all capital work in progresses, as well as our investments in the textile unit, BTPL. has contributed to capital outlay, but we are not counting any benefit coming out of it. It's just an investment. So ROC will improve as we progress. I think in FY27 we should start seeing a fairly strong ROC again coming back to us.
Pleasure talking to you, sir, as always. Thanks a lot for joining in. Hopefully next time around we'll have further clarity with regard to what's going on in the globe, and you can give us some more concrete guidance on the path ahead. Thanks a lot for joining in. For the time being, let's focus on Interglobe. The company reported a rather strong performance in Q4, backed by festivals, your weddings and the Mahakumbh as well. That's what took the profit number beyond the 3,000 crores mark. But to discuss what went on in the past quarter, how they see things moving ahead, we're joined by Mr. Peter Elbers, the CEO of Indigo, who joins us on the show. Hi, Mr. Elbers. Thanks a lot for joining in. Well, it's a sharp jump in revenue is what we're seeing. Could you give us some kind of a breakup? How much of it was led by the Mahakumbh? What was the increase in flights? And do you expect this now to fizzle out?
No, I think we have to look at what's the underlying assumptions we use for India. And with the growth of the economy and the growth of the GDP, we have set a long-term objective by doubling in size between 2023 and 2030. And that means we expect to have a significant growth year over year. Then in the year itself, we always see stronger quarters and weaker quarters. So if we look back to FY25, we saw, for example, that Q2 wasn't great. There was the elections, there was the heat wave. There were a couple of factors which were kind of dampening the growth. What we see then the quarters after that, and Q3 and especially Q4, were kind of picking up a lot in that traffic. And then, of course, indeed, specific events like the Mahakumbh create some extra traffic and extra demand. And Indigo has operated quite a few additional flights to Prayagraj and other cities in UP. But that in itself is, in fact, a reflection of the overall demand and positive setting. And yesterday, I think the DGCA released their numbers for April, and even April came in at a solid 9% growth of the market.
Okay, all right. Let's talk about FY26 then. Could we expect double-digit growth coming in FY26?
For FY25, we've given a capacity guidance in the early double-digit growth. That's the capacity guidance we have. Obviously, with an 87% load factor as we had in last year, that capacity guidance should not be too far off from the traffic guidance we're giving to the market. So again, early double-digit is the capacity guidance we've given for FY26 going forward.
Peter, hi. So Q4 has been good, very good, but the street is concerned about Q1, right? We had Operation Sindoor, a lot of people canceled their flights. What was the financial impact on the flight cancellations, on your network schedules? And how do you generally look at how have the months of April and May been for you?
Well, if we look to Q1 and the 3 months in Q1, let me just look at these in kind of separation. So April, we just mentioned, actually the quarter started very good and pretty much in line what we had seen in the months prior. So April was a good, as I said, 9% for the overall market. Then obviously May, and that includes, by the way, clearly the attack at the end of April, which was already there. Then clearly May had a dampener. The impact in May was for us 8 days, a closure of 11 stations and a total of 170 flights per day. That's a significant number. But then if I look to the overall operation of Indigo, we fly 2,200 flights a day. So if we take out 170 flights, it's still a relatively limited percentage of that. The same goes for the overflying limitations for Pakistan. We had to close or suspend rather 2 stations in Central Asia, Tashkent and Almaty. And we have another 34 flights which have somewhat extended flying times in the network. So the overall impact of that is relatively limited. And clearly what we have done is we reallocated some of our flights to the southern part of India and basically are growing from there. Post the ceasefire, the flights have been reinstated and all the 170 cancellations have been reinstated by the end of last week. And we're sort of back to a regular operation. That clearly has an impact on May, but again, it's more in the single-digit range when it comes to capacity impact. We have seen a drop in bookings, as we just shared also in the call. but that seems to have bottomed out. And actually, we see now the first signs of people picking up bookings again. And the resilience of the market is actually quite strong. And we expect, therefore, June to see again a performance which is more in line with the situation prior to May rather than the situation in May.
All right, what is the current outlook, though, for forward bookings as well as the fare trends for the upcoming quarters?
You know, we have not adjusted our capacity guidance for the year. We've actually just reiterated the early double-digit capacity guidance for the entire year. We have reiterated our capacity guidance for the first quarter. Again, slightly lower because of the cancellations in May, but we have reinstated all these cancellations after these 8 days of cancelling, and basically we see the traffic coming back. So for us, no change in planning and no change in expectation or outlook other than the month of May, which of course will have some impact on the overall profitability.
Got that. So April will be a bit of a subdued month. Can you take us through how was the air traffic and the yields and the outlook on the same?
If we look at the year which has gone by, the 4 quarters had a very distinct operation in terms of demand and even with that performance, and of course the price of the fuel also had its impact on the overall profitability. The last quarter had a very strong demand also in terms of yield. Quarter 1 and quarter 2 are traditionally weaker quarters when it comes to demand, and clearly quarter 3 is also always very strong with Diwali and the festive season in it. So I don't see any reason why this year would be very different as compared to previous years in terms of demand. What is adding actually to it is that Indigo is continuing its path on further internationalization. So we have stepped up significantly our number of international destinations. We're now into 41, and actually as recent as today, we announced the open for sale flights into Manchester and Amsterdam, operating out of Mumbai and starting in the first week of July.
Give us some more details on a couple of other aspects. Could you provide us with an update on the codeshare and the partnership with the Turkish Airlines? The lease is up for renewal on the 31st of May. So I ask you this.
I think it's important to recognize that flights between countries are governed and by what is called air service agreements, and that's agreements between the respective governments, and the same is in place obviously between Turkey and India. There's an air service agreement, and Indigo is operating within the guardrails, if you wish, of that air service agreement. That's one. 2, Indigo is operating in full compliance with the operation mandates and guidelines and opportunities and restrictions which are there by the government. And thirdly, importantly, we've had thousands of Indigo customers booked on those flights. The majority, by the way, connecting over Istanbul and connecting to other places. And we just wanted to make sure that we continue the operation, serving our customers, and making sure that they can either go to their destinations or come back from their destinations in the light that we had so many bookings. When it comes to a review of the permit, we await the outcome of the government and we will operate accordingly.
Okay, but in the event the lease doesn't get renewed, then what is the impact on your earnings?
You know, let me put it in perspective. Indigo operates a little short of 2,300 flights a day. That's the Indigo operation. We fly 2 times per day back and forth. So that's a total of 4 sectors to Istanbul. So 4 out of the 2,300. Then obviously these are larger planes, so you can move it a bit up in terms of percentage. But the overall scope is 4 out of the 2,300 daily flights we're having.
All right, final question before we let you go. Crude oil prices have been trending lower. How would this impact Indigo's margins, considering fuel accounts for roughly around, I think, 40% of the operating cost?
Well, thank you. Well, cost is, of course, an incredibly important part of the basis and foundation of Indigo, and maintaining our cost leadership in the Indian market, being such a highly competitive market, is incredibly important for Indigo. And I guess we have demonstrated over the many years that Indigo has been able to maintain that cost leadership. And that, by the way, will also help us now in the international arena where competition is different. And clearly we should also have and maintain our cost leadership. The price of fuel obviously is an important part of our cost, but in the long run, the correlation between ticket prices and fuel prices is always there. And it may not be immediately in the quarter, or maybe even not 2 quarters, but over time that correlation is there, because if fuel prices will go up substantially, it will have its reflection on ticket prices for companies just not to go out of business. If you look to the outlook for 26, I mean, I cannot do much more than repeat what some of these sort of international agencies are expecting in terms of a environment which is likely not to change. But I guess we all know that this can change pretty much overnight if something unexpected happens. And if I were to be in a position to make an accurate fuel projection, I guess I'll be doing something else than running an airline. So against that backdrop, we keep the agility. We have the youngest fleet, and with that, a very fuel efficient fleet. So I think Indigo is very well placed to, in case fuel would rise, to have the adequate planes for that. And if fuel remains at this level, to continue to operate with very attractive prices for our customers.
Peter, great conversation. Thank you very much for joining in. The Nifty still down about 1%, in line with the cuts that we're seeing across the Asian markets. IndusInd Bank, the expectation was that perhaps it's going to be, it's going to be under severe pressure in the morning. But look at the way IndusInd Bank is now back in the green. Top Nifty gainer, 3% up, 3.25% up on IndusInd Bank, and very close to that 800 rupee mark. So swift recovery from the opening lows on IndusInd Bank. Outside of that, in the frontline pack, you've got Colgate weak, 5.5% down on the back of numbers. Oil India is reacting to the decline in margins. Oil India has a cut of nearly about 4%. Dixon sees pressure for the second day in a row. It was the earnings miss of yesterday, down 5-6%. Another 3% gone on Dixon Tech. On the way up, it's IndusInd Bank. We spoke about Nalco, Prince Pipes. That's been one of the mid-cap stocks of the morning. Soni Patnaik is now with us on the show from JM Financial Services. Soni, on expected lines, we've had a big gap down. Now, what would you advise for trade?
Good morning, Rima. Thank you so much for having me on the show. See, I think Nifty may slide down towards its 20-day EMA support, which is around at 24,350 odd levels. And maybe, that's the level from where a bounce back or a buy on dip sort of a structure can get formed. But as of today, 24,650 to 24,700 is seeing multiple resistances, and the expiry could just be below these levels. So only the resistance is taken out. It may retest 25,000 again, but as of how the call writers are placing themselves at higher strike prices, possible that Nifty slides down and the profit booking continues for the day before seeing any, sort of a good buying back from those levels. So it's advisable to stick to stock-specific strategy, and a balance of both short and long side can be seen for the day. The first buy recommendation comes in Indian Hotels, which is approaching its 20-day EMA hurdle. It has seen a very strong bounce back above its 200-day EMA. So I think the stock does not sustain historically below the 200 EMA. Bounce back is quite strong from those levels. One can buy Indian Hotels at current levels for targets of 790 to 800, keeping a stop loss of 758. That can be seen. The second idea is a sell recommendation, which is an official recommendation that we've shared today with the clients. It's a sell in Grasim. So Grasim has seen a stock, a breakdown below 2,700 levels as per the option chain breakdown, and also below its 10-day EMA support. So one can sell Grasim futures with a stop loss of 2720 and targets of 2630 can be seen.
Thank you very much for that. Get into a break. On the other side, Manisha Gupta will join in to focus on commodities. Stay tuned. As promised, Manisha is now with us in the studio. Manisha, what's the one commodity that we should look at this morning?
Well, I'm looking at a couple of them actually, and sharp gains overnight is what we are witnessing in both of these. One is an asset class, which is cryptos. Bitcoin is trading at an all-time high of 110,000, and we've seen prices gain up quite strongly in the last month or so. Actually, since the time 2025 has started, we've seen very strong gains continue into this one. But for the month of May alone, we're up by 15% for this. Well, it is the usual suspects which have led to a lot of buying in cryptocurrencies as well. It is the softer US inflation numbers that led strong buying, de-escalation of the US and China trade war, and then Moody's downgrading the US credit rating. All of that led to money flowing into cryptocurrencies. And then Coinbase joining S&P 500 was quite a watershed moment. And on that day itself, we saw prices gain up quite strongly. But apart from that as well, when you look at the cumulative inflows within cryptocurrencies, and especially Bitcoin ETF, well, those have surged to almost $40 billion now. And then there is record liquidity that we also saw for Tether stablecoin. The US Senate has voted now to advance legislation to create regulatory framework in US for stablecoins. That has been supportive for that space as well. And then the US president also has said that before the Congress goes for recess in August, he wants to see the crypto regulations ready to sign by August. So markets are really hoping for a lot to happen before the time that we see August ending there. This is what we've done in sense of month-on-month buying, in sense of many of those US public companies. For 2025, they have seen 31% increase in crypto holdings, so far standing at around $340 billion. Now, when you see that number, that is 15% of all Bitcoin available in the markets. So very strong buying coming in from the coordinated markets there. This is what we've done in the last 1 month in terms of cryptocurrencies. The best of the gains clearly coming in from Ether at 46% up, but the other cryptocurrencies, including Bitcoin, is 19% up, and 10 to 15% of gains is what we've seen in the last 1 month itself, with very high gains now being talked about in this year and the next as well. But the other thing that I want to watch and bring to the table is the silver prices. Very sharp gains into this one. For this week now, we are up by 6% for the silver prices. With that, we're trading at a 3-week highs as well. And the silver prices have been inching towards that 1 lakh rupees per kg market in the Indian space as well. The all-time high that silver has done on MCX has been 1,03,000, not too far away from those kind of levels. And the kind of breakup that we've seen come in for silver, the expectations are that you could be reaching that level pretty soon. Well, we have seen decline in US dollar index. There also is safe haven buying that we have seen in silver. Also, when you look at the China and the EU market, the photovoltaic or the solar demand for silver has been quite on the stronger side. Well, 2025 is a 5th straight year that you're looking at global deficit continuing in silver. Last year was industrial production at record highs. The markets are anticipating that we're looking at record industrial consumption for silver in this year as well, and that perhaps could be supportive. The targets that people are putting out for silver is a support of 30 or 32, but the upsides could be 38, 40, 42 as well for this year. So that's the kind of bullishness that silver seems to be carrying.
Thank you very much for that. Get into a break. On the other side, we'll have the management of DLF joining in.
Welcome back. Well, the markets are under pressure, but good times for the broader markets because the number of stocks advancing now has taken over the number of stocks declining. So more green on at least in terms of the broader markets. But let's focus on DLF. That's a stock on our radar. For Q4, they saw strong growth in bookings, collections, while launches in FY25 exceeded the guidance, but that was on expected lines. We have with us Mr. Ashok Kumar Tyagi, the MD of DLF, who joins us on the show. Hi, Mr. Tyagi. Good morning. Thanks a lot for speaking to us here on CNBC-TV18. Well, just to blend earnings, stock markets and the IPL, well, the IPL gives us a chance, right, to watch super cricket, but it makes the cricketers wealthier. I say this because Shikhar Dhawan, in this week itself, he's gone ahead and bought a flat in Dahlias for around 69 crores. Woohoo! How many units of Dahlias do you plan on selling, once it's ready? For this year, FY26, if you could give us a number. And I'm just going by these numbers and I'm Googling as well, 60 to, I think, 120 crores. The profit margin will be huge, right, on these flats?
Okay. So you have asked a lot of questions in your one question. So yes, I also read the news about Mr. Dhawan buying the Dahlias, which is obviously very good. So, Dahlias has a total of, I think, about 430 odd units. We have sold about 190 odd of them so far. For the next couple of quarters, the sales would be relatively more muted on Dahlias. But I think we expect that by the year end, we should have our experience center ready, which should be the sort of, the launch pad for the next phase of focused sale on Dahlias. I mean, we have put out a 4 to 5 year timeline for selling out all of Dahlias because at that ticket size, obviously, you sell at a certain pace. I mean, we'll be happy if we do 4 years. Hopefully, we should do it that. Worst case, it could be 5 odd years. But that is broadly what it is. For the current year, I can't give you a specific guidance on Dahlias. But I can tell you that our total launch guidance, our total sales guidance for the current year is 20 to 22,000 crores of pre-sales.
But Mr. Tyagi, on this sales guidance for this year, 20 to 22,000, it's the same as what you did last year, which was about 21,200. Are you just being conservative? This number is going to be upped? Or do you think last year was an exceptional year?
So honestly, maybe it's a combination of both. Clearly, the Dahlias sales last year was an extremely positive surprise, even for us. That it will have such an enormous traction right at the launch stage. So in that sense, maybe those numbers were slightly higher than what we had originally anticipated them to be. If you recall, our sales guidance for last year was 17,000 crores, and we did about 21 odd. Frankly, Rima, while I know the market goes gaga about this pre-sales piece, I mean, we do believe that the two metrics that everybody, including the media, should really begin tracking now is the free cash flow and the embedded margins being generated. Because, if you sell 30,000 crores of stuff at a price point of 10,000 rupees a square foot at a margin of 2,000 rupees a square foot, is it really worth it? So we don't get too swayed by the pre-sales number. The pre-sales number for us is a derivative of the high margin launches that we make. And so we believe that as long as we stay in the 5-figure category for our free cash flow generation next year, for our embedded margin generation next year, and free cash flow by and large on track to what we did this year with a slight improvement, we should be good.
Okay, all right. When is the Mumbai project going to be launched? Every time I speak to someone who's developing in the northern part of the country, they say, y'all are jealous, the prices are going up too much. But when are you coming back to Mumbai?
Really? So I think this is our first project in Mumbai. I mean, really the first time that we are getting something on the ground. I think we should be hopefully closing out very soon. We are in the final throes of the approval process. I mean, in a slum rehab scheme with multiple slum societies, it is a more complicated, approval process than what, frankly, we were used to in Gurgaon. I'll be very transparent. But I think we are now almost at the business end of it. And I think we should be hopefully, filing for RERA approval, very, very shortly. And then depending on the time RERA takes, we should be ready to launch.
Any softness, though, in demand that what you have observed? Numbers, I think we've got most of them out. If you could give us two numbers now before we let you go. One is a qualitative aspect. Any slowdown are you seeing? And what is the rental income likely to look at for this year?
Okay, so the second point first. The rental run rate that we exited this year was about 6,000 plus crores. And we expect that the rental run rate by March 26 should be close to 7,500 crores across Cybercity and DLF, both parties put together. We should be at a 7,500 crores rental rental run rate by March 26. On the qualitative side of the demand, frankly, I think the demand continues to be robust. But what we have always maintained is that this is also also possibly the time when most responsible players also need to just ensure that they are not entering the speculative zone, either in terms of launches or in terms of price points. I mean, clearly, I think the demand is strong, but I think we do need to keep an eye on the future, frankly.
Mr. Tyagi, it's a short conversation today, but thank you very much for joining in. DLF has had a good run. Stock is up 8.5% this week, reacting to its numbers. With that, we close down on Bazaar from the entire team. Thank you for watching. Don't go anywhere. On the other side is Chartbusters.